33% top-line Azure growth is 4% beyond what the street said. But within that, there's a 16% contribution from AI. Those, to many, are just numbers, but they do seem to be evidence that the investment to date is now starting to translate to top-line gain.
You nailed it, and thanks for having me. The bottom line, if you look at that, that's actually 35% in constant currency. And what Amy Hood alluded to is most of that upside is just the Global 2000 migrating to cloud. And right now on Azure, they can't even keep up with demand on Gen AI. That guide of 34 to 35% was way above the street.
Let's talk about unable to satisfy current demand. There's an interesting, is it caution coming from Microsoft that, look, they're willing to be underserving in terms of supply because they are starting to normalize their spend in terms of capital expenditure?
I think they're trying their best to provision a lot of this next generation equipment, specifically NVIDIA GPUs. There is just so much demand. If you even look at some of the metrics that OpenAI put out last week of having a run rate of 174 billion in revenues, the demand is just outstripping supply, plain and simple. And their provisioning of new data centers with this next generation Gen AI stack infrastructure is just, they just can't keep up with demand, and that's a very good problem to have.
Yeah, so can we strip away that noise? We had note after note, analysis after analysis that in some way Microsoft was curtailing data centers, whether it be through leases or renegotiation. Is that happening, or is this the ebb and flow of doing business, Ted?
I think on the call, they tried to get to the root cause of this misinformation. I think you got a lot from the sell side that fiscal 26 CapEx will moderate. It can't go at the same level at 24, 25 when they were building long-term assets. And they define long-term assets as data centers with a shelf life of about 15 years. Those are shells. And the other shells that they're building, you know, they have to be hooked up to utilities. And I think the big thing that the street was kind of missing is time to power. They are somewhat restricted on these next generation data centers on just getting the power capacity needed to fuel the Gen AI load. So fiscal 26 will moderate. It's normal. It can't grow at 50% plus forever. And I think where the street maybe got it wrong was some of the analysts on the REIT side that were picking up some weakness. And, you know, quite frankly, that's a good data check, but probably not put in the right context if you understand core technology and what's happening in Gen AI and agentic AI.
Ted, my relationship with Microsoft is I grew up learning how to use a computer on their operating system. And more recently, I'm a gamer. Two pieces of news out today. One, Xbox prices going up because, not just on the hardware, by the way, on the titles themselves because of tariffs. But I always go to the Bloomberg terminal and look at the split of cloud and just like software revenues. They're still quite good at selling software that you can otherwise get for free somewhere else. Is that fair?
That's fair. And I think, you know, you look at Microsoft and they have a huge advantage as well as Oracle in relationship to the other cloud titans, whether it be Meta, Google, or Amazon. They already have the enterprise customer. So when you control the enterprise customer to begin with from previous revisions of whether it be, you know, Excel, Word, Outlook, and now, you know, you have a CEO, Satya Nadella, which is a visionary in tech that should be at the top of the list of CEOs that actually get the migration to Gen AI. Now you can leverage that entire base through Gen AI. And what's different on Microsoft that I think they brought this up on previous calls is Microsoft has a Gen AI stack that they've created over the last multiple years that's it's written once, it's unbelievably scalable. And when you leverage apps on top of that, you've got a model that few can touch.
Okay, let me jump in real quick. While this is all happening, Microsoft's a big contributor. The Nasdaq's now pushing to 2%. The S&P 500 is pushing higher. A big part of that, I know Microsoft's not sort of where it was at the open, but it was on track for its biggest gain since 2020. And I think that for all the sort of negative sentiment around the world about cloud computing and tariffs. It's a pretty astonishing moment in time in the earnings context, isn't it?
Yeah, and I think therein lies what's phenomenal about this guidance, Ted, is the fact that we got it. And what is it that we're starting to see? Is it that companies, despite macroeconomic headwinds, just see the shift, whether it be to on-prem to the cloud, whether it's movement from non-Gen AI to Gen AI, it's just so mission critical that they have to stick with Microsoft right now?
That's the right question. I mean, there's two aspects. All of Global 2000 has to migrate to cloud to lower cost, and that's what you do in a recessionary or a decreased growth environment. More importantly, what Microsoft said on their call last night was a little bit eye-opening on the guide of Azure being up 34 to 34%, 34 to 35% next quarter.
Yeah, growth.
And you're bringing the cost down on these models 2x, and their tokens, the Gen AI agent tokens, are off almost 50%. So the street had this huge debate on ROIC, return on invested capital. Well, Microsoft's reducing costs of Gen AI for broad adoption. And if you're in the S&P 500, if you're not migrating to Gen AI, you put your whole model at risk from an operating margin perspective.